Good morning. It is Thursday. It is the Bubba Show. And today, I thought we would talk about volatility and what it means to us as traders. You know, as the markets go through different periods of time, and everybody often wonders what creates volatility and what creates the VIX. The first thing is, let's talk about the VIX. The VIX is created based on the number of options that are being bought and sold. Okay? What that means is when there are heavy buyers of options, the volatility, the VIX index will rise, whether they be calls or puts. When there's heavy buying, volatility rises. For the last few years, there has been heavy selling, which means volatility falls. Why does that happen? When there is heavy selling, traders are convinced that the market is not going to make any big moves. Hence, the selling of options creating a lower VIX. When option buyers are in force, typically they're in force in both calls and puts, but typically it's puts, and that's why we call the VIX index the fear index. When we get the over demand to buy those puts, that creates fear in the market, that creates uncertainty. Markets that are uncertain create more volatility, which is what we're now starting to see. During a day, any given day, we can see a 100 or 150 point swing in a market because there is more volatility, because people are more on edge, creating a more volatile situation. It's no different than a crime scene when everybody's on edge. Things happen and we tend to overreact. So what's happening in the market, what brings back volatility, is when we overreact to one side or the other. So if you go back and you look at last week, Monday the sell-off was an overreaction. A lot of volatility. Tuesday was a bounce right back up. They took out some of the volatility. Wednesday and Thursday were down, created higher volatility. Friday was back up, less volatility. So the reason is because when complacency comes in, people are more likely to sell options, which then creates less volatility. And that's what we want to look for. But as traders and investors, we like much higher volatility because that creates much more opportunity for us to trade. So remember, the VIX, the fear index, is really controlled by the number of options being purchased versus the number of options being sold. Volatility is great for the market. It creates better opportunity for us, the trader, to make more trades and turn our cash over more times, which will create a bigger return on our investment. So let's root on for some higher volatility. And for Thursday, the Bubba Show, we'll talk to you on Friday, Commodity Corner.